Hi, welcome to 36 South overview of the start of year sentiment and positioning that exists within asset markets for 2026. My name is George Adcock. I'm the head of trading and the deputy portfolio manager for our flagship Cohenor strategy. The presentation that you're about to watch is part of a larger presentation which looked at some of the things that we said within 2025, the sentiment positioning piece that you're about to watch, and some analogies that we see with previous market periods. The presentation will focus on what we believe are relatively lofty expectations for asset prices and what that might translate into looking forward. If you could please take a minute to read the disclosures on the screen. If there are any charts or content within the presentation that you find interesting, please feel free to contact us using the link that you can find in the description of the video and at the end of the presentation. We'll be starting by looking at some of the volatility data that 36 South collects in the foreign exchange options space and what that might say about the sentiment of the market moving forward. If we go back to the start of 2025, one of the observations that we had made was that from a kind of sentiment and positioning standpoint, which is one of our investment factors at 36 South, we were seeing kind of like very, very high levels of jubilance. And we're starting to see the same conditions today. And generally, that starts to create the preconditions for a period of market weakness. And we'll go through those charts now. So within 36 South, we predominantly trade options and use options and volatility structures to create asymmetric portfolios, and we are predominantly involved with the tail hedging of portfolios. And by that we mean trying to hedge the kind of the risks that exist within portfolios, and that may be on a left tail perspective, which is what people might traditionally think, which is generally like equity assets falling, the world getting slower, and right tail assets, which is like large scale kind of accelerations in things like inflation, which can have like deleterious effects on a portfolio. In doing so, we track a large number of options markets across the world and try and understand what's good value, where are the kind of where is the market giving you a free lunch, and where is kind of like the exuberance coming from. Now, in doing that, we have built a large database of foreign exchange options that we collect every week, and we try and look at the percentile of those going back as kind of as far as we have data. And looking at those option prices gives you quite a good window into where the market is kind of discounting like very, very normal times ahead of it. And as I said kind of earlier, you get this kind of, you're more looking towards the preconditions for volatility. So the chart in front of you basically says, of that 750 options, how many of them are in the bottom 15th percentile? And what that really means is that if you're thinking about the combination of an FX forward and the FX volatility piece, that the option prices are really, really cheap relative to their history. Now, what you can see is that recently, prior to the kind of wash news from the US, we've seen that nearly like 45% of our option database was in the bottom 15th percentile. Now, when you go back and look at kind of analogous periods where this has happened, we've generally seen kind of like higher volatility levels ahead. On the far left, we've got the kind of exuberance moving up into the GFC. We got to this kind of 45% level in kind of the back end of 2026. We saw this again during the middle of 2014, which was really just before the dollar had a very significant rally against most currencies. We had a very large oil shock. We saw something in 2019, which was a sort of preceding conditions to the COVID shock in the middle of 2021, where we started to see unprofitable technology start to weaken. And in 2022, we had, a relatively significant shock from energy bonds moving together. And then into the start of 2024, we had this kind of Liberation Day expectation, although I would say that the dollar dynamics have been slightly different within the last couple of years to what we've seen more recently. One of the indicators that we looked at the start of 2025 was effectively within the conference board, they do a survey of how many participants expect higher or lower stock prices. And what we've generally found is that once this gets to a value of 30% net expecting higher stock prices, it pays to be a bit more concerned or a bit more cautious within your positioning. And what you're going to have is a situation where the market either needs to grow into those expectations, or we're going to have to see some weakness to reset expectation and where portfolios are. And we saw that right at the start of last year, and we're back to those levels today. On top of that, we see, and with this data, it really pays to triangulate it. We've seen this corroborated by other parts of the kind of investment analysis landscape. In front of you is a chart that's taken from the Bank of America Global Fund Manager Survey. And what we can see is that we are now at the record low cash ever. And what that really means is that the market is very invested on the kind of status quo conditions kind of playing out. And what we're starting to see is that the odds that the status quo conditions continue to play out looks increasingly low to us. Going back to that kind of theme about triangulating how we should think about these kind of sentiment surveys, there's another survey that we'd like to look at, which is the AII cash allocation of investors. And generally, once we get down to a level of around 15%, once we're below 15%, what you start to see is that the forward returns of asset prices generally start to struggle. And that's what kind of the chart shows you in front of you, with those periods highlighted, over the last kind of 20 years. And what you're seeing is that they've, become increasingly regular previous versus the kind of 10 years prior. So when we triangulate those three things together, both the conference board expectations of higher prices, the very, very low cash levels, and the AII cash balances, we can see that we have kind of the ground set in front of us looks a bit more shaky than where we've come from. We want to generally be thinking about owning asset markets when there's incremental capital that's going to be chasing them to come in. We generally want to be thinking about reducing exposures when everyone is within that trend. Now, one of the reasons for kind of like this very kind of aggressive positioning is driven by one of the things we've mentioned earlier, where we've had this competitive devaluation pressure that has driven kind of a debasement kind of rhetoric, and that has made participants believe that liquidity conditions are absolutely excellent. And what we have started to see in the data that we pay for is that is actually not so much the case. And there is, some incremental evidence you can see from January where liquidity driven assets like precious metals have started to have a harder time. Now, when you look at this chart from Bank of America showing, how many people are expecting these positive conditions, you generally find that these are the times where it makes sense to step back from risk taking. 2007, just before the GFC, March 2011, before kind of this Eurozone and US debt downgrade. 2013 maybe being a slight outlier, but during that period we started to see kind of the EM sell-off within currencies. Jan 18 was the blow up of kind of XIV, this kind of short vol, kind of heavy short vol market. September 2021, we were thinking really about, Cathy Wood, ARK, unprofitable tech starting to slide, and then, inflation creeping in and increasing kind of energy prices, bonds selling off quite meaningfully, took us from very high liquidity expectations to very low expectations very, very quickly. And then in more recent times, very similar, like we said previously, December 2024, very high expectations of asset price returns, very high liquidity. And, during 2025, in the first quarter, we got quite a big asset class shakeout. Just going back to one of the comments made from the previous slide, we follow the cross-border capital, actually renamed Global Liquidity Indices by Michael Howe. And what we've started to see is in Michael's data, which has been pretty reliable, this liquidity dynamic has really started to deteriorate. And you can see that on the 3-month percentage change on the right, we've actually dipped more down to kind of a negative reading. And, the big takeaway here is kind of the divergence between the data that we see and kind of what is observed within the sentiment surveys. And that kind of dichotomy creates the preconditions for kind of market shocks. The other thing that is just worth noting, and I've just used credit as an example here, is that the market is like increasingly kind of becoming priced for perfection. Like to incrementally buy asset prices in many markets. This is just US credit spreads. You're really betting on things moving to kind of record levels where you're not being that adequately compensated for taking the risk. So when we add up all of these pieces together, what you end up with is, kind of the embers underneath the kindling from our work that say the forward conditions are likely to be probably more volatile than we've been used to in this recent trend. We've got relatively high asset price, and we've got very high expectations of both liquidity and asset price expectations going forward. And for that reason, you want to be kind of probably in the first quarter, at least of this year, slightly aware of this dynamic when thinking about your portfolio. We hope that you've enjoyed the presentation today. If you'd like to see more content like this, please subscribe to the YouTube channel or follow us on LinkedIn, where we post regular updates. We'd also welcome any comments about things that viewers would like to see in future, or topics that you'd like us to cover. And we look forward to seeing you soon.